This TwinPetes Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the TwinPetes Investing podcast. My name is Peter Higgins and you can find me at Conquers3 on Twitter. And I'm here with my good friend and colleague Peter at Wheelie Dealer on Twitter. This is TwinPetes Investing podcast number 57. So we're heading towards our 60th anniversary soon. Pete, how are you, fella?
Well, yeah, mate, I'm just usual thing. I'm okay, but I've got this ongoing issue we all know about, and I'm bored senseless by it. So, whatever, let's carry on.
Okie dokie, mate. All right, you keep ploughing on, mate. All right, listen, ladies and gents, thank you for coming back to us. Thank you all for your fantastic feedback from all over the world. We are blessed to have you still listening to us and putting up with our little isms and schisms and noises and other bits and pieces, but today's a very special podcast in many, many ways. We're going to be talking about the event that I've put on with Lemming Investor in Leicester. We're going to talk about that in a minute. But I've got two, not just one, two fantastic guests on this podcast coming up shortly. I'm not going to tell you who they are, but the vast majority of you listeners will probably know who they are once I say their names a bit later on. They're going to be coming up in about 10 minutes, so watch that dial. They're coming. They're going to be absolutely phenomenal. Pete, I just want to jump straight in and get this over with regarding the investing event that we're putting on in Leicester to bring people up to speed with it, right? And then we're going to get our guests on. First and foremost, ladies and gents, I've got some fantastic news in a sense of where we are with regards to how much monies, funds and all the rest of it that's been generated so far. We've had some further donations and sponsorships. I think I spoke about it last time. We've got ShareScope, obviously that sponsor the podcast, and they're on board. They're going to be providing us with lots and lots of support, and they're going to provide a half-year membership to SharePad ShareScope as a raffle prize. So they've donated £1,000 to the podcast, and we've got
this is for the Menphys charity.
This is all going to the Menphys charity. There's no money being taken by anybody whatsoever.
What does that charity do, mate?
It's a disabled charity, Pete. It supports the young children and their families and their carers in the community with lots of different services. So this is what the TwinPetes has been about and what we're raising. I'm trying to raise a minimum of 10k, ultimately trying to get to 15. So that's where we are with it all. I just want to tell you who we've got on board so far. So we've got obviously the main speakers on the night, who are Orphan PLC. Formerly, some people know them as Venn Life Sciences previously, and they are engaged in the pharma services business, and they're engaged in looking at all the different aspects of rare diseases. And then you've got Poolbeg Pharma. It's a clinical stage infection diseases company. They're going to be presenting on the night. So there are two main speakers and sponsors. And then we've got Stephen Thompson MBE, former rugby player who played at the position of hooker for Northampton Saints and England. And he was a rugby union World Cup winner in 2003. And his company, or is a director of Powder Monkey Brewing Co. So he's one of the sponsors. His company's one of the sponsors of the event. So we're going to be he's going to be bringing some ales to the event, Pete. So we've got lots of nice ales, so people can have a little taster on that. And obviously we've got London South East, who have sponsored the food. London South East is one of the UK's leading share information websites for private investors, providing share prices, stock quotes, charts, trading history, chat, interviews and marketing, etc. And this is a novel thing that I got called yesterday, Pete. Via, I think you know him as well, Alex Schlick. Yeah,
Alex Schlick from Yellowstone.
Yellowstone Advisory, and he's saying he wants to because they work with some fantastic companies and do PR and marketing for some fantastic companies. And essentially, Alex is a former stockbroker and fund manager and is active private investor as well. And he founded Yellowstone Advisory, which is an investor relations and corporate advisory business, and it helps small businesses with their investor relations. Now, they've got an event on the 16th of September that they're hosting, a webinar with Capita, which is obviously quite a large company as well. And Alex has basically said to me that if all or as many of our listeners, and those that use Twitter, follow his Twitter handle, Yellowstone Advisory, which is at Ystone Advisory on Twitter, he will donate £1 to the Menphys Charities TwinPetes Challenge Just Giving page. At the end of the year, the number of people that he's got, for £1 for everybody that's been added, it will add to the TwinPetes Challenge. So if we can get him from 465 currently to 1,000, he will donate £535.
Lovely.
Okay, so please start following him now on Twitter as soon as you hear this particular message going out. Okay, Pete. So we're
thank you very much to Alex. He's a good guy, and he covers a few companies that I'm either invested in or interested in, and great to hear that he's contributing to charity. Fantastic.
Yeah, I mean, the bizarre thing is that he gave me a heads up. He said, "Look, I know you like your pharma companies. Have a look at this company. It's got loads of moving parts to it. You would be interested. I know you're going to do a lot of research on it." And he introduced me to Tech Capital. I did the research on it, and it's up nearly. Well, I think I got in at sub 11.5, and it's at 30 odd now. So he's got a good eye. What he should have as a former fund manager, I suspect. You know what I mean? Yeah. So he introduced me to that company, Pete. So I'm quite pleased with the progress they've made so far. But our total at the moment, Pete, is £9,382.
Oh, that's brilliant.
Right? I mean, so you've had a massive jump of over 2,000 since we last spoke, I think. And that's because Elric, who's my co-partner in this event in Leicester, at the Small Company Champion, at Lemming Investor on Twitter, has donated another £500, and he wants to sponsor the booze for the night. So everyone's going to get a free drink on entry and some drinks on the table and all the rest of it. So he's added £500, £1,000 from ShareScope. Little Lynn, I think she might be a friend of yours, Pete, says, "My goodness, you guys make me laugh. You are my go-to source for down-to-earth investment, education, and entertainment. Keep up the great work, and thanks so much." £30 plus £7.50 gift aid. And then one of Elric's subscribers, which is Sharon Gallagher, donated £50. Great effort for a great cause. And then a Twitter personality called at Market Gem, I think his name is Riaz, has donated £50. He said, please keep up the great work helping investors and the amazing charity work that you do. Thank you, Riaz, for that £50. Ian didn't give his name, donated £50 plus £12.50 gift aid. Our great friend at Scrumpy222 once again donated another £10 plus gift aid. And then we've had Glenn Bradshaw donated £30 plus gift aid. Thank you, Glenn. Good work, guys. Always listening. And then I think Terry gave us again to us. Great team effort. Two Pete's provide education and listeners provide an audience, and Menphys do very important work in the community. God bless and take care. So that's everybody there that's donated so far to the charity. And I think by the time we get to the event, which is on the 17th, we'll be at 10k. You can make a donation on the TwinPetes Challenge Just Giving page, which is justgiving/fundraising/ TwinPetes Challenge. Thank you. So for everyone that hasn't heard about the event yet, we've got Poolbeg Pharma, Orphan, we've got a Rugby World Cup winner and other special guests turning up on the night, talking about the resilience of life, business, sport, obviously investing, and we're going to be talking about lots of different things going on about, you name it, and it's going to be very entertaining with great food. So please register on the Eventbrite page, and I'll give you the name for that particular Eventbrite. It's just the Menphys page which is the Eventbrite page for it, and it is. Let me just read this out for you, Pete.
Yeah.
It's eventbrite.co.uk/e resilience in business, sports and life, and you're just searching up for Eventbrite for an evening of networking and the best in sport and life, resilience in business and sport by Menphys, and you'll be able to register. You need to register relatively quickly because it's going to be filled, and we need to make sure that you all get registered so you can get your appropriate goodie bags and food and drink. So please register now.
Excellent. Any problems with doing the registration, obviously contact me or Pete, me Wheelie or Peter Conkers free, either DM or email, whatever, and we can send you the link and stuff so you can get yourself sorted.
Cool beans. I wanted to throw one extra thing in there as well. For those of you that are travelling far and wide to get to this event, or those that aren't but want to stay overnight, I've also organised so that you guys and ladies can have a 15% discount on your accommodation at the nearby hotel, which is the Holiday Inn accommodation hotel, 2 miles I think it is from the event. So you get 15% off your accommodation, possibly food as well, for an overnight stay on the 17th of September. Okay,
that's fantastic.
Pete,
one thing I don't think you've mentioned was, do they have to pay anything to come to this brilliant
Sorry,
event?
mate. Yes, of course. This is a free event, ladies and gents. Let me just get that in there. It's a free event. I'm trying to cover all the bases and cover all the costs with all the different sponsorships that we've got. So free food, free drink. You know, all we're asking you to do is rock up, have a really good time, buy the odd raffle ticket because we're going to have some raffle prizes. We've got some, what are they calling those little things you stick in your ears now? Pete, my brain's gone. The Apple Pods?
No, I think they're called cotton earbuds or something. Yeah?
Apple earpods. We've got some booze.
Yeah.
We've got some investing books. We've got some psychology books. You name it. We've got a couple of raffle prizes, and we've got some more coming in as well on the night. Now, I'm conscious I've been rambling on for about 10 minutes now. We've got some really significant people who you're far more interested in speaking to.
Yeah, mate.
Listening to.
I'm dying to know who they are.
This is a quick hello to you, our valued TwinPetes Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe and you'll always be the first to get the new episodes. Thank you for your continued support.
Right, okay, ladies and gents, for your pleasure, listening ears, and for your investing education, I've got two of the most noteworthy individual in the investing game on our little podcast. The TwinPetes podcast are ratcheting it up a level. We've got two of the behemoths of the game on the podcast, and they'll probably be embarrassed of me saying that, but they have got a brand new venture that's coming down the pipe, and I'll let them tell you what the name of that venture is when they come on the podcast. But these two individuals have done significant work in educating investors far and wide for decades. And one of these individuals is John Hughman, and the other is Phil Oakley. And they've got a brand new venture called, I'll let them introduce themselves and tell you what it's all about. Phil, John, are you there?
I'm here, Peter. How are you doing?
Good. Hello there, John. Hello there, Phil. How are you both?
I'm good. Yeah, I'm really
all
good.
Right, thanks, Pete.
Thanks for having us on. I think you've definitely oversold me.
Right. The thing is, John, everyone thinks they know you, but they just know you from Investors Chronicle. But you've done so much prior to that, and the fact that you were an equity analyst before that, and you did work in the city before that. I want to just, make sure that we give you some coverage and speak to you about what you did previously and what you and Phil are going to plan and do going forward regarding this new venture. But first and foremost, whether it be you or Phil, please tell us what it's called.
Over to you, Phil.
Go for it.
Over to me, is it?
Yeah, go on, Phil.
Okay, so we're going to launch a new website in the next few days, and it's going to be called Investability. And the name has actually been drummed up for a couple of reasons. In that we are looking for companies, and we're going to talk about companies that have investability, but also a large part of our site is actually about helping people ability to invest. So that is the sort of spiel behind the name. But without sort of making it too complicated, we're just really going to keep on what we've been doing for goodness knows how many years now, and getting back to staying with old-fashioned, what we term as sort of old-fashioned investing, which is, going back to basics, kicking the tires of companies, kicking the numbers, looking at business models and explaining them, hopefully in an easy to understand and engaging way, so that basically our readers or future readers can help make their own mind up about investing, rather than trying to piggyback on other people's ideas, which we have very strong views about and think's very dangerous. So we want to encourage people to fish for themselves and have a bit of fun and interest while doing so.
That's exactly right. I mean, we won't be tipping. There will be no tips as people have come to to kind of expect them on Investability. We'll also be relaunching the podcast that we used to do as well. So the Quality Shares podcast will be new, and hopefully that will be what people want to hear.
Sounds absolutely fantastic, guys. I mean, what I want to get from you both with regards to the new website, and I'm really, really pleased that you guys are back. I saw the outpouring last week when Phil dropped a tweet to say we're coming back. Look out! This is coming down the pipe, and there's been a massive outpouring. You guys have been so missed. Not solely for all the articles and all the podcasts, but generally just for educating people. There's a big void out there. There's far too much, as you call it, piggybacking. I call it hoarding and copycatting. Of people just all being clustered in the same stock. So if you guys are now back and be able to help people, fish for themselves, as you say, and research for themselves and improve long term and invest in quality stocks, that would be absolutely phenomenal.
Really looking forward to it. It's good to be coming back. I've had a much needed break. Been out in Suffolk, where I've moved to. And actually, I've just moved again. With the benefit of hindsight, trying to launch a business and moving house in the same week is definitely a bad idea. Do not do it ever. But it's good to be back. Maybe a little rusty, but I'm sure back in the saddle, get into the swing of things very, very, very quickly. And I'm looking forward to as you mentioned, Peter. I used to be an analyst, and I spent a lot of time running a publication, and really sort of being a kind of facilitator of other people's writing, and I'm really looking forward to getting back in the analyst game myself, and having a proper look at companies like I used to, but many years ago.
I think what's interesting, John, and I'm hoping you can just give me some clarity here. Obviously, before, right, Phil was sending you work which you would check, or someone else would check on your behalf. What's going to happen now when you and Phil are writing stuff? Who's checking who?
We're gonna check each other's, and I'm sure there'll be a few more typos than I would have traditionally been happy with. But it's actually the sort of those sort of things. Design, website functionality. They're kind of that's a lot of window dressing. Actually, what we said. In fact, what I said on Twitter to all those many people that wished us well was, it's going to be a triumph of substance over style. It's about the research, it's about the analysis, and hopefully as we get a bit more au fait with how this the sort of technology behind it all works, we'll improve the site. But it's about the words. It's really about the words.
Cool, Phil.
Yeah, I mean, we've deliberately set out to essentially have a bloggy feel to it. It's not going to be. We haven't spent a lot of money. We're pretty happy with the website that we've built, but it's very much going to be a bloggy feel to it. John and I are essentially becoming a couple of bloggers with the sort of freedom that comes with that, which I'm quite excited about. But it'll be simple, easy to navigate, very similar to what a lot of bloggers use. But as John says, it's all about the content, and we're hoping to have a very high standard of content on there, which has a long shelf life. It'll include in-depth analysis of companies. We intend to be very balanced about this. We'll tell readers what's good, what's bad, what we're thinking about. We will take into account things like forecasts and ask questions about whether we think there's upside, downside. We'll also have a weekly newsletter, which will have 3 portfolios running on it for starters, but we intend to add different portfolios as we go along. Those will be educational portfolios. They won't be tips. They're meant to show the ins and outs and the practicalities of investing. And of course, we've got our podcast. And then, of course, John. I mean, people haven't really seen John write any sort of research at all for years, which is what he used to do. But John will be doing a daily email as well, and that'll be free, and that will give John's view of the world and draw attention to what's going on site. And then John is going to do his own company and sort of industrial take. And he'll talk about a bit of economics as well. So what we're hoping is that, it won't take very long for the site to fill up with hopefully lots of good stuff that people can come back to and take a lot of lessons from, and it'll help them with their investing.
Yeah, I think sort of the daily email, which as Phil says, you can sign up for free, and I'm going to be looking at sort of more the macro side of things in that. I think whilst we're going to be doing the in-depth company analysis, I think you can't ignore the geopolitical, the geoeconomic backdrop. It has implications for companies down the road. So we're not going to ignore that side of things. It's a really important foundation to really understand sort of where the world is going, how it's moving, and the fact that we can do this, the fact that we can build a website for the limited amount of money that we have, the tools that are available. It's really come on. 10 years ago, you couldn't have done this, and it's a real indication of where technology has taken us. We'll come on to that because I think technology as a sort of investment has also perhaps got a bit carried away, or people have got a bit carried away with those sort of companies. I'll be looking at tech. I'll be looking at pharma. We're going to split the sort of coverage up a little bit. But yeah, it's really exciting.
Excellent. I'm just going to let Pete in here. He's been very, very quiet. I think he's stunned into silence, which is rare for Pete. Pete?
Yeah, no, it's fantastic to hear. I mean, it's a weird situation for me because it's like I'm sort of talking to two of my heroes, So it's I feel really quite honoured. I mean, I've been reading John's editorial column in Investors Chronicle for, God knows how long. How long have you been doing it, John?
9 years. I made 9 years. I didn't make a decade, unfortunately.
Yeah, no, that's cool. I mean, I've been a subscriber to Investors Chronicle for probably 20 years or something, and I sort of remember you coming on the scene, and then it sort of seemed like you've been there for quite a while. So it's great to hear that you're back and whatever. I remember reading I think you have done a couple of articles in Investors Chronicle, but not very often because obviously I presume the editorial job is a pretty demanding, heavy-going job. So.
Yeah, it was pretty heavy going. Actually, you're right. I did occasionally sort of dabble. I wrote something on testing last year, COVID testing. I did something a while back on tech valuations. Which actually we did really well with that. That won one of the CFA UK articles of the year, along with the guy called Phillip Ryland who wrote the other half. I have dabbled, as it were, but yeah, I'm going to be sort of diving headlong into it now.
Yeah, no, I'm sure you're going to enjoy it, and it was interesting what you guys were saying about the sort of freedom of a more of a sort of blogging kind of way of doing things, because obviously, I'm a bit of a blogger myself, or some people will say a blagger. I'm a bit of a blogger myself, so I very much value that freedom. The fact that it's I don't have to answer to anyone. I mean, obviously you two have to work together and sort of answer to yourselves as partners, but you've known one another for donkey's years, so that's fine. And no, it's an interesting thing to do. So Phil, I mean, it's fantastic because I actually met you, Phil, didn't I, about 5 years ago? I think, or 4 years ago.
Yeah.
Yeah, I think it was a mellow event. I think we pretty much just said hello, and that was all we really got a chance to do.
I think that was it. Yeah.
Yeah, and I think Tim was there from ShareScope as well, wasn't he? He's moved on or whatever. But I absolutely loved your column in Investors Chronicle. So thanks for all those columns you wrote, because not only were they, interesting and useful to read, they were like, most I think were probably about 3 pages long, and it was good, analytical, in-depth stuff of quality companies. And quite often they would be companies I was interested in, or they would be companies that I held, or whatever it was. And it was always a really useful column. And I did cry a bit when I saw that you weren't going to be writing in it anymore. So to hear that you're actually coming back is fantastic news.
Oh, thanks for those kind words. I mean, the intention is to keep on doing that. Except we'll be doing it for us now, for our website, and we are going to do endeavour to do the best that we can and keep the quality high and keep our customers happy. That's what it's all about. That's who we're answerable to. We're not answerable to each other. We'll be answerable to people who are, we're asking for money every month, and it's interesting. When you work for yourself, and you work for a company and you're a salaried employee, you lose that detachment. And I think when you start doing something on your own account, the importance of that is first and foremost in your mind all the time, and it's something that we're very keen to get right.
Phil, that actually reminds me of something that you've often said on our podcast and written, is that the companies that put their customers first tend to be the companies that really thrive. You've seen Amazon do that. You've seen Games Workshop, for example, do that. It's something that we've learned from our time as analysts, and we're going to apply it to our business. Customers come first.
Oh, that's fantastic. I mean, the other thing you've sort of talked about 3 parts of it, and then a monthly charge, presumably. So you're doing, was it the freemium model? I think is the word for it. So what have you sort of worked out what the monthly charge will be and things like that yet?
It's going to be. So we're going to start off. It's going to be £15 a month or £150 a year.
Well, that doesn't sound bad. I mean, that's for the quality that I know you guys will write. That seems, a price worth paying, sort of thing.
Well, we hope so. We hope so, Pete. I mean, it's. I think one of the things we're very conscious of is that we have to offer the customer value for money, and we will try and get the right trade-off between the quality. We won't sacrifice the quality of what we write, but we want to give people plenty of content. We're not going to charge that kind of price and write, 1 article a week or, once a fortnight. There's going to be plenty of content on there. So hopefully the customer is getting a good deal for their subscription.
It's interesting because a million years ago in another life, I used to subscribe to a thing called T1PS sort of tips, which was what Tom Winifred did, and it was actually not bad, and the good thing about it was that it sort of did teach you a bit about how to invest in quality companies and whatever. And they had some really good, interesting small cap companies that Tom used to have on there. And I think there was, I can't remember what was it, James I can't remember what his name was. James, somebody used to write for him, and he was pretty good, and that was like quite a good thing. But obviously, Tom's gone down different rabbit holes these days, and he does a lot more sort of the more sort of bottom end of Amy kind of stuff, which wasn't really what T1PS was about. And the thing is, in terms of like things like that you can subscribe to, there aren't really that many, and there certainly aren't that many that are any good.
And this is the beauty of what you guys are doing now. You know what I mean? In the sense of bringing forth the quality stuff, because that's what you guys are renowned for. You know, in-depth, analytical, objective, balanced writing, and this is what people need. I think what happens, unfortunately, on and across social media and in journalism and in politics, there's a lot of groupthink going on, and it causes all kinds of problems. So if you can have somebody or an entity such as yourselves coming forward and writing objectively about stuff, and writing about the good, the bad, the indifferent, and not taking sides on something, it enables the actual reader, the investor, you know, new, old, experienced or otherwise, to actually learn about how to get through all the noise and actually make a decision, or not, or choose not to do something, you know. And I speak to Phil, and Phil says, you know what, I'm probably better at saving people money, you know, because I can find out, I can identify the things that are going wrong. So it's quite important, I think, to keep educating people, and that's exactly what you guys are going to be doing. I wanted to talk a bit about the 3 portfolios, if I may, guys, that you said you're going to cover, and how they might differ, and also, you know, historically, John, you guys tended to cover higher quality stuff and didn't talk about the lower tranches of the FTSE or AIM. What sort of areas are you going to be covering in the sense of stocks? And I know John said he's going to cover macro. We'll talk about that a bit later on. But what's your coverage going to be regarding stocks from blue chip and downwards? What's it going to be?
Yeah, I'll pick that one up, Phil. You can talk about the portfolios. I mean, we're not going to cover everything. You know,
of course not. Yeah.
So you know, in my former life, you know, we had to cover all bases, and we don't have to do that now. We can be much more selective about what we cover. We'll focus on larger companies. So, you know, FTSE All Share, probably the top 100 companies on AIM, and then be very selective about anything else that we look at outside of that in the UK market. I mean, the small cap market we struggle with, mainly because, as you mentioned, Peter, you know, this herding that takes place, this sort of this endowment effect that you see on Twitter. You know, people who own shares really don't want anything bad said about them, any questioning of the bull case. So that's a tough market to be in, and the liquidity is often so poor that, you know, a buy recommendation, a bit of positive news can send the price soaring, and you know, that's fine when you're on the way in, not so fine on the way out. So we're going to focus on areas where there's good liquidity. We're going to look at funds and investment trusts as well, but from a sort of bottom-up perspective, what do those funds hold? Why are they good ways of potentially playing themes or whatever it might be? And we'll selectively look internationally. I mean, we were talking about this the other day, Peter. The UK accounts for, I think, 3% of global market cap. That's tiny. So you know, we are firm believers that you need to broaden your horizons, and there are some amazing companies, particularly in the US, but in Europe on the sort of green investment, green energy side of things. Some extraordinary companies out there that UK investors would be mad to ignore.
I think you're right there, John. I mean, and I'm guilty of that myself. You know, I read widely, and I'm looking for all kinds of stocks from all around the world, and invariably I think, okay, so what's the UK the UK one that does this? And I'm like, you know, and I have got some overseas stocks now, you know, European stocks and some Australian stocks, but the vast majority of my portfolio and everybody else I speak to, it's very UK centric, and we're mad to keep doing it, and I'm guilty of it, guilty as charged. I really need to diversify out of the UK.
Do you know, it's a funny one, because I've actually gone totally the other way. It sounds really contrarian, a bit nuts, but I used to do more overseas than I do now, and in fact the only real sort of overseas thing I've got is PayPal, PYPL, and what has sort of happened with me is that I don't like the currency risk, for starters. That gets on my nerves, And with PayPal, I've actually got it as a long spread bet. And incredibly, I've held it for like 6 or 7 years or something ridiculous. But because I've held it as a spread bet, I'm betting pounds per point. So it's still in sterling for me. And I also get tax benefits from it. And I also get leverage. So I find it's a really brilliant way of buying overseas companies. And if you understand the risk, understand what your exposure is as if you had normal shares, then I find it is something that works really well. But yeah, I've sort of like retrenched to the UK in a sense, because I find there's more than enough excellent companies in the UK. I don't need to complicate my life by spending time looking at America, looking at Germany, looking at Australia, whatever. I don't need to do it. There's so many great companies in the UK, and I would rather. It's a bit like, you know, that book, The Zulu Principle by Jim Slater. The whole idea of the Zulu Principle was that sort of anybody, if they apply themselves, can sort of learn a lot about a very small subject. So my very small subject is UK quality stocks, be they small, large, whatever. And I just try to specialize in them and learn as much as I can about them. And then I sort of exploit that to get my gains.
It's definitely, there's nothing, I mean, that's you know, an approach, and I don't think there's any one right approach, and I think this is why, you know, we don't really want to go down the sort of hard tipping approach, because, you know, what's right for one person to buy is not necessarily right for another person. What approach is right for, you know, what investment style is good for one person is not necessarily good for another, which is why I think, you know, education, teaching people how to make those decisions themselves and work out what it is that's suitable for their portfolio. You know, that's where we think we can add value. But you're right. You know, you can do what you want and should do what you feel comfortable with.
Yeah, it totally makes sense. I mean, interest in what you were saying there about how, you know, educating and not giving tips. I mean, I was saying earlier about T1PS and whatever, and I learned a lot from that in the early days. The interesting thing is, now as things stand, there are some very, very good, I think you'd call them tip sheets. Yeah, there are some very good ones out there that people pay money for and whatever. But the bottom line is they only give tips. They don't give any kind of educational stuff. So if you can give, you know, a good background as educational stuff, as well as talk about some interesting stocks and all the rest of it, I think there's a massive potential for that. I think it's absolutely the place to be, to teach people about accounting, teach people about macro, teach people about whatever, you know.
Yeah, absolutely. I mean, the other reason I want to look overseas is because of the sort of the context. You know, so yeah, we live in a globalized world, and you know, these. Yes, there are some industries which are, you know, very, very much, you know, confined to the UK shores. But unless you look internationally, understand the big competitive picture, you know, who's out there buying company, who's a potential acquisitor of a UK company, you know, it's a whole new world that actually has a massive impact on UK shares. So actually understanding those international competitors is important. So we might as well write about them.
Yeah, no, that's a great idea. And the thing that I perhaps should have added when I said I don't sort of hold many or any overseas shares. The funny thing is, I actually do hold a lot of shares that have a lot of overseas exposure. So, for example, I hold Diversified Gas and Oil Company. No, Diversified Energy Company. It used to be Diversified Gas and Oil Company, DEC, and that only operates in America. I own Somero, SOM, which had some, you know, great trading update today and has jumped to load, thank goodness. That again is really just predominantly like 90% or something, or 85%, you know, operating in the US. So I sort of get exposure to overseas, but it's sort of a bit different.
Mm.
So Phil, with regards to the portfolios that you're going to be running, I know you've got a penchant for looking at American stocks, because there's obviously the behemoths, and the quality of them is sometimes of even better quality than the quality we've got in the UK. What's going to be your focus regarding those three portfolios?
Okay, I mean, just on the American side of it, I mean, I'm a massive fan of the American stock market and the companies that are in it, because I think that the quality is vastly, vastly superior to what's on offer in the UK. And I think that the stockbrokers are getting there. They're making it easier and cheaper to trade American shares and overseas shares, and they're not where we'd all want them to be, but they're getting there.
I mean, for a long time, Phil. Sorry, just to butt in, that they were being a bit naughty with the foreign exchange. They were making far too much out of the foreign exchange on that.
I think they probably still are, which is something you've got to bear in mind. But the thing as well is, the development of the exchange traded fund market now allows, you can buy S&P 500 sector ETFs. So if you like a particular sector of the American market, you can now buy that very easily, very cheaply, and get your exposure that way if you want to. But in terms of the other thing as well is the disclosure that you get from American companies. Even if you're not going to buy an American stock, I think if you're owning a UK stock, a UK company that has an American peer, American competitor, go over to their website, go into the investor relations section, read their annual reports or what's called a Form 10K, and you will learn loads of information about the industry, the business, the risks, the markets that you just do not tend to find in UK investor websites and publications like annual reports. It's a great way of improving your knowledge about a UK business as well. But going back to Pete's question about the portfolios, I've got 3 portfolios. So the first one and the one that's been going, these are portfolios that I've run for probably the longest one is about 4 and a bit years, and all of them apply my sort of approach to investing, which is good companies that are very resilient to bad things happen to them. They stand up well in a recession. They're very profitable. They are very good at pleasing their customers, and they can grow. And trying to find those type of businesses at the right price is quite hard. But I've basically set the portfolios up into 3 things. I've got one called an Atlantic portfolio, which is largely American shares, but there are some some UK shares in it. Now, this portfolio, once upon a time, was my personal SIP portfolio that I had to sell before joining my previous employer. I was happy with that, but I kept the portfolio going for journalistic purposes, and I've still kept it going, and now building up a reasonably long track record with that. So that's that one. I've then got a total UK portfolio based on the same approach. Both portfolios have about sort of between 20 and 25 shares. And I will also put my personal SIP portfolio on there as well, which I've only just set up again, having moved workplaces and reinvested and started buying individual shares again. So I'm going to share that journey. And those 3 portfolios will form a discussion point in the weekly newsletter that we will publish, which will also contain 6 to 8 short analytical pieces about companies in the news. So the great thing about running portfolios is not just the practical side of it, but it also, from a purely selfish point of view, generates a lot of ideas for writing. And it's something that we know people like, and hope that people will keep on liking it when they come to us.
Okay.
You might see a full.
So Phil, just go back just a tad there regarding you called it the Atlantic portfolio. Could you give us just 2 examples of the sort of either the size or the name of stocks that you immediately thought, you know what, those 2 stocks need to go into the portfolio because of what they do and the moat they've got and the highest of quality that it's got? Where were you looking?
You mean what companies or what sectors?
What two companies have you could just throw out right now and say, look, these are the top two, or these are the two companies that are in that so people get a feel as to what what sort of companies you looked at immediately for that portfolio that used to be your ex-SIP.
Yeah, so one of the companies that I talk about from time to time on Twitter is Costco, which
yes, of course,
is a retailer. And then another one is I'll give you a UK one, a company called Croda, which has changed a lot in the last sort of 18 months. It's always been a good business, and it's done things like specialty chemicals, and done things like making sort of skincare products, sun care products for global consumer goods companies, but also doing things like crop rotation, seed management, and it's moved into a couple of new areas via acquisitions in the last year or so, which has transformed it. It did look like a company that was losing its way, and it looks like it's got back on track. And I think that's one of the best companies in the UK market. It's priced accordingly, which is a separate discussion. Mm-hmm. But those are two types of companies. They're not giving away the whole list.
Yeah, that's absolutely fine. I mean, my dad will be pleased you've said that, because that's he owns probably that and probably one other tiny little stock, but that's where most of his wealth is in Croda, because that's where he worked for all of his life, or most of his life, before he retired. And he just tells me off every time I mention it, because I should have bought them when I was about 21, and I refused to buy them because he was getting two for the price of one in his work scheme. So yeah, that's my loss. His gain.
I mean, what there is on the website, launch, is there is quite a detailed article on the website that will describe what these portfolios are, the principles of how they've been put together, and the characteristics that I look for in them. And so you sign up and you'll get a really good insight into that. And then through the weekly newsletter, you just go on a journey with it. And this is the great thing, and I'm sure you'll agree with this. So the great thing about being an investor is that nothing stays the same, and a company will come up and it'll announce something or do something that will be different or interesting, and it has so many lessons in it. And that's essentially the essence of our website. We're all still learning here, and what we're trying to do is try and learn about companies, explain them, but actually share what we learn as well. And the best way to do that is by running portfolios, because that's what most of the readers will be doing themselves.
Absolutely.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a TwinPetes Investing podcast listener, you can access an exceptional offer via SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special TwinPetes offer is available to new subscribers only, and you can subscribe using the promo code TwinPetes. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe to SharePad today using the TwinPetes promo code, and you can save up to £69. Visit sharescope.co.uk/SharePad for further details, and subscribe to the investing and trading analysis and data you need.
So John, you said you were going to set a portfolio up as well, didn't you?
Yeah, I think I'll have to. I mean, because obviously
I'll have to.
Both Phil and I were obviously in our corporate pension.
Yes.
Very generous indeed. But now I can do what I like with that. So that's going to go into a SIP, and there'll be a fourth portfolio up there as soon as I've decided what to put in it. But I have an absolutely blank canvas. I can do what I like.
Okay. So have you got any leanings though, John? Have you got a preference? Because you like your tech. I know you like tech.
Well, the thing is, I do like tech. I mean, it's it's game changing, it's world changing, but you have to pay through the nose for it.
You have to. Yes, you do.
And I do think that there's been people have got carried away with the story that and forget that there is a physical world out there that doesn't operate or tech is nothing without the rest of the world behind it. So I do think it's you've got to be careful not to get carried away with tech. I think tech in the UK is pretty poor, generally speaking.
John, stop there. It's not. I have to disagree with you. I don't think tech in the UK is that poor. It's good, but every time we get a company that is up to any scratch, it gets stolen, mate. It gets taken over.
Stolen.
So we never ever end up with anything that's a behemoth.
That's capitalism for you.
Predators just come and just grab it, and no one says no to it. All our big and good and useful companies have been taken, and now we're fighting over Arm, what Arm can do, long after we've sold it.
Oh, Arm was a fantastic company,
Fantastic company.
But then equally, it was never a great performer on the stock market. The numbers
they didn't rate it. We don't rate our tech companies.
But it wasn't making the money. It was, you could say, okay, let's take the long view because it's tech, it's Arm, it's tech. But even now, it's been it was a very disappointing investment for SoftBank.
Yes. To be fair, I agree with you.
So it's a great company, but yeah, it just lacks something. And actually, if you look at when I say tech is poor, I do mean at the larger end of the spectrum.
Yes, we don't have any.
Indeed, rather than sort of innovative small caps, and we will be on the lookout for that sort of thing. But I think our biggest tech company, I can't remember now if it's Ocado or Just Eat, but both of them are essentially food delivery companies, and I really struggle to equate them to tech, despite what they would say. So yeah, I do like tech, and I'll probably be looking over at the US for that. And I think there's some good gems hidden, bit below the radar, sort of just outside of the kind of real sort of the FANG market. There's some really great companies that I'll be having a look at, and yeah, who knows though.
Okay. I mean, the thing is, I was speaking to somebody recently about, and it might even have been Phil, about Sage, the behemoth that's now a small, not necessarily a small cap, but a lot smaller than it used to be, as a tech company. It's trying to catch up with the innovative companies that have eaten its lunch over the last few years.
Well, we've had to buy some accounting software, of course. Now we're
of course,
running our own business. And let's just say we haven't bought Sage.
Oh!
Yeah.
Fair enough.
So yeah, I'll keep watch this space. My investment portfolio will appear at some point. Just to say, I have invested over the years, but for my kids mainly through funds. It bought them things like FundSmith, Scottish Mortgage. I've done really well.
I was going to touch on that because I didn't realise that you guys were going to be doing analytical writing and talking about funds and investment trusts as well, which I think gives a nice breadth of what people are actually doing now. People want security of pooled investments, I think, as well regarding funds. So the fact that you guys are going down that route as well, that's really, really good.
Yeah, I mean, absolutely. Phil benchmarks his portfolios against some of those large funds. So the Blue Whale, FundSmith, some of Nick Train's funds, and I mean they're good. Funds are good. It's hard to match the performance of some of these great investors, but it's also a bit fire and forget. And actually there is a lot of fun to be had in investing. I love researching companies. I love writing about companies, reading about business, and investing in individual stocks and shares is fun, and it's something I'm really looking forward to.
Excellent. Sorry, Pete. Go on. You had a question in the middle there. Sorry.
Well, yeah, something I wanted to sort of throw in Phil's direction really was I know Phil in the days of Investors Chronicle used to write a lot of good stuff about accounting and understanding accounting. And I think it's one of the areas where private investors are sort of lacking. I think where I think that a lot of people see accounting as an incredibly difficult subject, and I think if there was some good stuff written about simplifying it and keeping it, what do you really need to look at to avoid problems and to make sure you've got a half decent company and all that kind of thing. and I think there's big scope for that. Are you sort of planning to do much along that sort of vein?
Yeah, I mean, accounting is. I'm not an accountant, but I have spent 25 years. I've done a lot of accounting courses and things like that. I've done, I've even done bookkeeping in the past. So, actually putting accounts together and stuff like that. So, I'm not saying I understand everything, but I understand generally how numbers move around a set of accounts, and I've tried over the years to explain that. You get the odd hiccup, we're not infallible. You can misinterpret things, but yes, that is something we want to do. But we are mindful. I am mindful that it is a very, very dry subject and has a very high capability of sending people to sleep.
Yeah,
and I think it's the context of how you explain accountancy. So yes, there will be. I mean, people who know my stuff will know that I touch on these issues, and we do intend. I will write some simplification stuff as well. I think if you were going to boil it down, you could probably put down maybe 6 to 8 key measures that you should always check when you're looking at a company. But the problem, the point that I want to get across about accountancy and numbers and stuff is that numbers are important, but what numbers do is they confirm the business that you're looking at. And it's very, I know there are people who invest by numbers, and they're called quants, and they invest purely on numbers. And I've got some sympathy with why they do that and how they explain why they do that. But I think it's you're investing in businesses, and I don't want to think that people to think that investing is like a painting by numbers exercise. It's about first and foremost, it's about understanding businesses and business models, and this is something that I have consciously tried to change about how I invest and how I write about investing. When I started out, I'm trying to cut down the amount of number work that goes into my articles. Where it helps to explain stuff, I'll put it in. But I'm much more interested now than actually getting to understand, the business itself, how it works, what it offers customers, and what it does against its competitors. And really, the numbers are a kind of a confirmation about whether your reasoning is right or not. I think you can come out the other way. It's very easy. And SharePad is brilliant for this, and I use it a lot. You can very easily and quickly screen for companies with certain kinds of characteristics, and then you go and look into the business behind the numbers and see if you're comfortable with it. But one of the things that we both agreed that we will write about is that we will look at different ways of finding good companies. John will say this, and John is a great believer, as am I, of just getting out into the real world and using your eyes and finding good businesses.
Absolutely, it's one of my favourite investing books is by a guy called Phillip Fisher. And he advocated what's known as the Scuttlebutt Method, and it's basically that. You go out, see, look at the world around you, see what people are buying, see how customers are interacting with businesses. If you can, go and speak to suppliers, speak to anyone in their sort of supply chains, and if you can, go and speak to management as well. It's always good to look in the whites of their eyes, which is something I remember doing as an analyst, and you can tell a lot. You can tell a lot by that, but yeah, getting out there. Seeing what's happening is really important. Sitting in the pubs in Suffolk, you hear some extraordinary things from farmers. And it actually all sort of trickles through into the stock market ultimately. And that's I love that approach. But as Phil says, I think you can get misled by that. So you've got to really then do the legwork and back it up with the numbers.
Yeah, I totally agree with that, because I've come across examples myself, and I'm actually got someone I'm sort of helping to learn how to invest at the moment, sort of thing. And one of the difficulties I'm having there is that this particular person, he's a great guy, but he's having a sort of, he's very much a numbers driven kind of person. And one of the things I'm having to try and get him to do is to think more in a qualitative way as well as a quantitative way. Because I think I'm more from the sort of qualitative, and as Phil sort of said, it's really what the business about, the business model, the growth potential for the business, how good the management are, what's going on in the business. That's really what drives the numbers, and the numbers are almost a sort of, they're just another part of the big picture, you know. And to just obsess about numbers is, well, you know, it's if you're just going to obsess about numbers, you might as well just program a computer and get the computer to do it for you.
I agree. I mean, one of the things I've always thought, I mean, markets are markets, and in fact, the economy, it's just people. It's just the collective result of what billions and billions of individual people do. So yeah, it is qualitative in essence. It translates into something numerical at the end of the day, but ultimately, investing is about people.
Yeah, that ties into another thing that I wanted to bring up. Have you considered, you know, are you going to write much about psychology, do you think, in the process, in the fullness of time?
I think so. I don't think you can avoid it. I think psychology is so important in markets. You know, we're seeing it in full effect now. I think you know, Peter mentioned herding earlier. You know, we see the whole meme stock trend. You know, whatever's going on in the crypto world is driven by psychology as much as anything else. You know, behavioural finance is massive. Ignore it at your peril, and we won't.
No, I totally agree. I mean, I think it's such an important subject, and something that in the last few years I've paid so much more attention to, and it's just fascinating, I find.
I saw a couple of amazing tweets recently that really struck a chord with me. And one of them describes, you know, global stock markets as an everyone's getting rich except you market. So this fear of missing out is driving a lot of behaviour. But of course, we only hear about the success stories. We don't hear about people who've lost money, generally speaking.
We generally don't, John, because as Pete and I always find out, and you will see on Twitter and social media now that you guys are more free to do that, is that, you know, when things are going up, everyone's talking about the stock, and when things aren't going so well, it's very, very quiet. I mean, there's a great tweet and commentary was written by one of your former colleagues, Tim Harford, and he's, to quote him, he says, "Groupthink persists because groupthink feels good." You know, and I counter that and I say, well, sheep just get slaughtered, you know, because if you're all herding together and you're all doing the same thing, no one's actually thinking, you know. And I see it repeated at least once a week or at least once a month. There's another stock that's just gone up and then goes whoosh, comes down again. And I see people going in and chasing the next herded stock. And I'm going, come on, don't do that. Don't go in that stock. But everyone's piling into the same stock. And it's like, how do you educate someone enough so they get the right psychology that, you know, goes back to what Phil was saying about, you know, learning to fish. You've got to learn to think for yourself, because people rely on the psychology of you being, you nearly use the word induced then. But, you know, they're trying to get you to not think for yourself. You know, just follow me. And I'm not saying don't follow me. Do your own research. Read some books. Get some books on psychology. But I think people want the easy route.
Yeah, unfortunately, I mean, it's. I mean, my former colleague Algie Hall has written brilliantly on this, and he actually wrote an article that won him CFA UK Journalist of the Year last year on behavioural finance. I mean, it is a great article. I'd encourage.
Yeah, I read it. Algie's really good at that copy. Yeah,
absolutely top drawer. But you know, something that he's often said is that, you know, actually we are, you know, we're sort of we're living in this really sort of information-rich world with all this modern technology. You know, anything you want to know at the press of a button, wherever you happen to be, and our brains have not evolved in you know, thousands and thousands and thousands of years. So these behaviours that kept us safe when we were sort of wandering the plains, make it difficult to be really good investors now. Our natural tendency is to do these things, to herd because there's safety in the herd. But it isn't always, it's not in investing that necessarily the right thing to do. So it's just about self-awareness, I would say. Before you press the button, understand why you're pressing the button, or if you're hanging on to something, understand why.
Absolutely agree. I'm reading a brilliant book. I try to find some books. I mean, I keep raising Phil's book, but I try to find other books as well, which no one else is reading. And there's a really, really good book. I'm not sure if you guys have heard of it, and I'm reading it as we speak. It's called Non-Consensus Investing, Being Right When Everyone Else Is Wrong. And it's by Rupal Balsali. Brilliant book, Columbia Business School book. And it's honestly, some of the things that you're reading and some of the stuff that she's come up with in this book is really phenomenal. And it touches on all the psychology of what's going on, not only individually, but corporately and, across all the investment industry. And it's fascinating stuff.
I read something really interesting recently on kind of equity research, sell-side equity research, and kind of what's wrong with it. And consensus, it drives equity research. The reason you don't get outlying views in equity research is one, because of obviously the corporate broking relationships, but two, because nobody wants to be the one who makes that crazy call.
Absolutely. Unless, of course, you Phil Oakley, who doesn't mind sticking his foot or his head above the parapet every now and then. Hey, Phil?
No, I'm not sure about that these days. I mean, no. Yeah, I mean, I think, just going back to the point, and I think it's a very, very topical point about herding, almost tribal thinking around certain stocks that are flavour of the month. And one of my biggest concerns, I think, about investing in general, but particularly private investing, is that there's a lot of stories peddled about, and there's a lot of talk about how great a business can be. There's very, very little balance added to that in terms of what are the risks. And you see people coming out and saying that they've got an investment that's completely knocked it out of the park, and you get a lot of people saying well done. I will say well done, but I will also say that return was achieved by taking on huge amounts of risk. And the whole thing about investing is that if you want to be a successful investor, you have to embrace some form of risk. If you can't take risk and accept risk, then you shouldn't be investing in shares. And one of my big themes, and you'll see it a lot on the stuff that I write and John will write, is about getting the trade-off between risk and potential return. And going back to what both Petes were saying a few minutes ago about people piggybacking and herding, the real problem with that is that sooner or later you'll piggyback into a stock that you haven't done you don't really understand it. You don't know what it does. You don't know the ins and outs. You don't know the risks, and it blows up in your face. And you don't know why you've lost. And one of the biggest lessons that you can learn as an investor is you learn from your mistakes. And you learn more from your mistakes than you learn from your successes. And this control of risk and the lessons that you take on is what I firmly believe is the key to getting good long-term returns from a portfolio of shares. And you do it by avoiding companies that blow up in your face. Because if you get a stock that blows up and it's a meaningful size of your portfolio, and this is the other thing, you're seeing a lot of investors having huge concentration risk in their portfolios, owning even single stock portfolios. And if they go well, their returns are going to be fantastic. But if they go badly wrong, they're going to be eaten out of the bins. And it's about getting the balance right. And I firmly believe that there isn't enough talk about it. Now, that's not to say that you know, we're going to go uber bearish on loads of stuff. We're not. You know, as I've got older, I've become better at accentuating the positive amongst anything in life, and I think that's the same with stocks. You have to have that positive mindset, but you also have to, you know, walk out of the door every morning with your eyes open, and just a bit of balance, I think, is sometimes needed. And you know, we will talk about bad companies, we will talk about bad companies because we believe that the lessons for investors are just incredibly valuable, and have a very, very long shelf life, and you can learn what to avoid. And if you can learn what to avoid and avoid those blow-ups, we think you've got a better chance of doing okay, or more than okay.
I think the words bullish and bearish, actually, I mean, just think about it as you were saying it, Phil. You know, I don't think we want to be either. You know, it's what is the positive and negative case for a company? What are the risks? What are the opportunities? You know, and we're not going to come down on one side or the other. Ultimately, that's for people to make their own minds up about. But bullish and bearish, as Phil says, it has that sort of tribal feel to it, which is possibly where a lot of these sort of problems come from.
I would have to agree with you. I think this is the beauty of what you said at the outset, that you're going to have balanced, objective articles, so people make their own minds up and learn how to assess and analyse companies, so they make their own decisions. You know, I think a lot of articles are now written with a view of, you know, I've got to write it bullish because I want to get people to purchase the stock that I'm in. You know, and without even disclosing that, you know, said writer has bought that stock or is in that stock. A lot of it is I think you touched on it already, John, is you know, illiquid stocks as well. You know, so if they do get an increase in volume, they're going to just soar, you know, within the next 3 or 4 hours or the opening of the market, because it's been tipped by a tip sheet somewhere. So, and people, I think they get used to that adrenaline rush and that fix. But as you've both pointed out, the problem is when it's a liquid and it's going the wrong way. And we've seen it over and over again where these stocks have just collapsed 30, 40, 50%. And it's just silence. It's like tumbleweed across social media. No one's talking about that stock anymore. And they're quiet about that stock for a little while until they're ramping their next stock. You know, rinse and repeat.
Absolutely. I think, you know, across the media as well, there is a tendency to sort of err towards the sensational, whether
Yes.
good or bad. And actually, you know, in investing, often great opportunity can be found in stuff that's really, really dull. Really, really dull. You know, Phil, we were talking about Ashtead the other day. Pretty dull. But it's been a great stock.
It's been a massive stock. I think Pete and I only spoke about it recently. It's probably the best performing stock from the 2007, 8, 9 crash. You know, absolutely smashed it out of the park as a penny stock, and it's now sitting where it is now, you know, and still growing and still doing well. And it's just not one of them stocks that people talk about. And I keep saying to people on this podcast, do your own research, but, you know, if you can, find some stocks that no one's talking about, you know.
Absolutely. The other really dull thing, of course, is dividend reinvestment.
Yes. drip, yes.
And compounding, you know, I mean, it's so dull. There's not really much to say about it, but it's where a lot of long-term returns come from.
Completely agree.
No doubt about it. I think people massively underestimate the importance of dividends. I mean, I'll just give a really simple way of looking at it. I personally am looking to make 10% a year CAGR, you know, compound annual growth rate on my portfolio. As long as I'm doing 10% a year, I'm a very happy bunny. Now, the thing is, if I hold a load of decent quality growth stocks in my portfolio, that gets me 2 to 3% from the dividend payments towards my 10 already. So I'm already, you know, well on the way to achieving what I need. And I think simple things like not over trading, not trading very often, that probably gains me another 2 or 3% compared to what a lot of other people do, just continually chop in and out of stocks. They're running up dealing fees, they're running up stamp duties, they're running up timing costs, of the fact that you can never sell at the top, you can never buy at the bottom, and you get all these different costs that come in that people just do not understand and do not realise.
That's a very good point. What very well made there, Pete. I think what I'm going to do at this juncture,
just to butt in, sorry, just when Peter mentioned 10% CAGR as a target, and those numbers, like if you think about the sort of the kind of market we're in, if you said to perhaps a less experienced investor, oh yeah, a good return is 10% a year, they'll laugh in your face. I made that in a day on Bitcoin. So expectations of what you really should be looking to achieve as an annual return are perhaps too high in many quarters.
Yeah, again, like you say, John, it's changed dramatically over the years, and also because of the accessibility to said portfolio and to the ability to buy and sell and trade so frequently and so quickly, that's what's caused it, I think. And people want instant gratification. I think that's the main problem.
Yeah.
Okay, guys, what I want to do is just have a quick pause here, right? I think we've got a bit more to talk about, and then create a second sort of little segment for this podcast. If you guys are up for it, if you want to carry on talking about some more about the website and what you're doing.
Yeah, good for me.
Yeah, I'm happy to do that.
You're happy to do that. Okay. So, ladies and gents, we're gonna close this podcast off here, very, very momentarily, and this is going to be part 1 of said podcast with John Hughman and Phil Oakley regarding their brand new website and venture called Investability, which is going to be a must subscribe for you all going forward. And also they're going to be doing their own fantastic podcast as well. So please consider signing up, registering for their emails and all the rest of it. And we're going to come back in a few minutes with part 2 of this podcast. So don't go too far. We'll be straight back.
This TwinPetes Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.